You have to enable sharing too when you're ready.
1 second. All right, I made you the co-host. You should be good. And 11.
Let me know if it shows up.
Yeah, I did. Just make it full screen. Like if you hit view, you should be able to make it full screen.
Boom. Thanks.
There you go. Perfect. All right, let's get started. Thank you guys for joining us for our July. Well, I can't believe it's already July monthly webinar series. Usually I bring on a special guest. Today is no different. I'm bringing on Anthony Khan, but today I get the pleasure of actually bringing on one of my partners. Me and Anthony, Anthony and a third partner, John, we do the affordable housing syndication. So it's a great pleasure to actually bring him on, but we're going to feature him today instead of me bringing on a third party. So just a little backdrop for me and Anthony. If anybody's read my book, in the first chapter, in the introduction, there was a point where I invested in a certain operator and Anthony turns out invested in a certain operator. And when COVID first started, this operator just did their largest acquisition. So the operator thought it was a great idea to do an open house for all his investors to come out and actually check it out. The only issue was that this deal was in North Carolina and you couldn't fly there. So I reached out to this operator and I said, hey, do you know anybody else who's going around in this region? This way, at least, you know, and we could carpool together. It's about an 8-hour drive. Turns out Anthony was thinking exactly the same way and asked the operator the same thing, almost the same day. And the operator connected us via email. And I remember this conversation with my wife and I was telling her, hey, I'm going to be taking this trip. Are you okay with this? And my wife was like, you don't even know the person. You've never met this person. And I said, no, he invests in real estate. We should be completely fine. Turns out within like 15 minutes of that car ride, me and Anthony were talking about half the different asset classes that I invested in were exactly the same asset classes that Anthony's done. And, you know, the 8 hours flew. We ended up basically hanging out all weekend, but I also met a lot of other great individuals during that trip. But it was just, we had, I think, such mutual respect from that trip. And for the next 2 years, I think we floated this idea of potentially partnering. Finally, Oxford Village presented itself. And, you know, we jumped right in and we started working together. It's been about 6 months, but more, I think it's been closer to a year since we actually started underwriting and doing due diligence. And we get along really, really well. I like to keep things bigger picture. Anthony is just so much more of a detailed person. So combined, we make a really, really great team. And that being said, I want to introduce everybody to Anthony Khan. Maybe give you a little bit, maybe Anthony can give a little bit of background on himself and then start the presentation on affordable housing.
Yep. Thanks for the introduction. And yeah, so I'm Anthony Khan. I'm been living around the Philadelphia area for the past 15 years. Actually, 2009, we bought our first home, and that's when we got started in the real estate side. A fixer-upper that became my house for 12 years until I left the city. And I started off like most people with single families, and then just growing from there and going to duplexes, triplexes, commercial mixed use, apartment buildings, and just kept sizing up. So we started going from 4 units to 6 to 8, 12, and 22, 50 now. With Dennis, we did a 50 unit, and we're looking at 100+ units right now. But it's just progression and getting comfortable with jumping to the next level. So we've been selling a lot of our single families and smaller units, and ones that have not are more difficult to manage, more time, and plowing those resources into these bigger affordable housing projects, because we can, through this, we are actually able to control the management and the maintenance, which is huge for operating a property and returning a better profit. So when I had all these different properties, I had about 7 to 10 different property managers, and when you're working with the property managers, there's very few that have interest in making your business profitable. So a lot of times my rent check would go to the property manager, and I realized that, if I'm not in an area where I can control that and have my resources on hand, it wasn't beneficial, and your margins were cut down a lot more. So we actually held on to a few properties. We have about 3 properties that I manage still within half an hour of where I live. And I'm in Villanova, just outside of Philadelphia now. So we moved to the suburbs, raising our family. And so I still manage a handful of them where I have my own resources in play, and the margins are worthwhile to keep them for the time that we have to put in. But we've been expanding out on the affordable side, and I kind of stumbled into this with having a few properties with different housing authorities in New Jersey and in PA, and I realized that you're getting, like, I had tenant-based voucher properties where the housing authority is paying 90% of the rent, and the tenant is only paying 10%. I actually had bought a small property that had like $700 per month rent. I bought the property like $34,000. We put maybe $5,000 into it. But the tenant was already in place. We were able to raise the rents up to like $925. It was that big of a gap between the market rate and where that rent was. And then every year we continually raise the rents, like whether it's 3% or 1, 2, 3, or 5% even. This past year, I think it was a 6 to 7% increase just on the market rates. But obviously, some places were going up 200% or 100% on rents, which was insane for some areas. But just kind of giving you that background that it was a progression of steps that got me to the affordable side and got me more interested in that. So we'll walk through and give you an idea about how this works and how it's different than your regular fixer-uppers or just add value properties. All right. So Dennis, is it okay to jump in, or did you want to say something else first?
Yeah, I'll just say one thing really quick. If anybody has any questions, we'll make sure to get to them. There's a Q&A button, or you could just write into the chat. You could actually just put it in. I'll be monitoring that, and then we'll get that. Around 3:40, around 5:40 p.m. Eastern time, we're gonna switch to Q&As. So don't be shy. Just put them in there, and we'll definitely get to every question you guys have.
Right. And I'm not sure of the experience level of some of the folks on the call, so I'll go do the high level overview of most of this stuff, and we can definitely go through questions at the end, like you were saying. So we're going to talk more about this from the affordable point of view. Any investment has a risk. We're not soliciting a security or anything like that here. This is just our typical legal statements that we have to put out there. I'm just going to provide an overview of what we've done and what we're working on, so you have a good understanding of how that works within the affordable industry and how that's different with the multifamily real estate side. These are based on some projections, but I'll be able to provide some actuals that we've been working on also, since this is based on a property that we closed on in March. So 4 months now, and we've had a lot of good things happening to learn and adjust our budgets and other things like that. All right, so investing in affordable housing. This was one of the first things you think of is just kind of down in the dumps, rundown places. You think the projects in New York, those kind of places that the government had built. It's nothing like that from what we're working on. We're working on much higher end kind of living environments for people. Actually, I like to say we're redefining affordable living, and that's basically what we're doing. We're raising the bar for it, and the amenities available to the tenants and everything. So just making it a nicer style of living for them. So just like multifamily, you have a lot of the same benefits. There's inflation rate concerns. You're working, having the right team to operate is super important. Some of the differences we have the housing and urban development, which is HUD. That's the federal level, and they actually provide funding to every state. And then the state provides it to the counties, and the counties provide those vouchers to the tenants or the properties. In our case, we have both. We have vouchers that are assigned to our property as well as to the tenants. So we own the ones that are assigned to the property. So, you know, a tenant leaves, that voucher stays with us. So it's actually, it's pretty good. It's a better way to have it where, you know, the tenant doesn't want to leave because they're going to lose that income if they leave your property. The affordable business plan is more about cutting down the high expenses and learning how to do that. And also being able to raise your rents up to market rate and being in compliance with everything. So it's a different arbitrage there than your typical add value where we're just, let's go redo the units and charge another $200, $300 a month. Or what, you know, that's your typical add value kind of property upgrades. So we're focused on like a lot of our off-market deals where we have some sellers in our back pocket that we work with, and that creates less of a bidding war on properties, which is always nice because it's crazy what some of the properties on market have been going for. There's a smaller buying pool, but there's pros and cons to that, but I'll explain the pro of why we're focused on this, because there's an affordable period when you're buying properties. And it's like it's a 30-year period for these, there's something called low-income housing tax credits. And when you develop an affordable property, you get these credits, and basically it's the government incentivizing you to build affordable housing, because no one can develop a B-class, C-class property or get that kind of rent with the cost of development nowadays. So the government has to incentivize it, and they do it through tax credits. So I'll talk about that a little bit too. So we'll also touch base on the case studies, like I mentioned, of what we're actually doing and what we were projecting. All right. Actually, I'll mention also the pictures in the background is they're townhomes. They're 2- and 3-bedroom townhomes that are one of the properties. It's called the Oxford Village that we purchased in March. So it's beautiful, and I think that's the ones throughout the deck, right, Dennis?
Yep,
they're all from the
absolutely.
village. Yeah,
all from the village except for I think 2-3 pictures are actually from the town, but okay, it's all from the Oxford property.
So it just gives you an idea. It's a nice standard of living and a great quality product. So the benefits, the inflation concerns, and working with the right team is what we'll start off with. So some of the benefits, there's the cash flow. You basically receive a share of those profits in the form of cash distributions. Obviously, that's like any investment. You want to get your dividends on a regular basis. So there's that. One of the big things that you see today is inflationary hedge. Inflation's been out of control, and I think last year was 6-7%, and this year is over 7% already. And we still got a good portion of the year to go. So when you're dealing with real estate, everything's going up with that. So your job's not going to give you a raise based on inflation happening. They're not going to go, okay, hey Dennis, here's your 8% raise this year because we want to match you with inflation. Your job's going to probably give you a 2 or 3% raise or something like that. When you're investing in real estate, you're basically hedging inflation, because as the cost of living goes up, so does your rent, so that you can handle that volatility much more easily. And keep in mind, versus the stock market, you're sitting on an asset. So the stock market's everyone, I guess, a year ago or two, the stock market was booming for five years straight. So everyone's like, you can't lose in the stock market, right? Why would I want to do real estate? It's the stock market's so good, and now it's got cut in half recently, right? In real estate, you always have an asset there. The stock market, your businesses, like some of them you invest in. I've had some that were at $90 a share, and now they're down to $10. Who knows if some of those companies will go under, right? That could happen too, and then you have nothing. When in real estate, you have an asset backing up your investment.
And
Um,
let me jump in for a second. So
yep.
one more thing I want to add to the inflation hedge thing is not only are you able to pass on inflation in the form of rent increases, you also, even before that, you also can line up the right mortgage product where the debt is actually fixed. So in our situation, on last purchase, our mortgage interest was 3.83%. Now, if the inflation is 5-6%, then we're actually arbitraging, and our property is actually getting cheaper because our debt is not our interest rate is not increasing with inflation. So that's also a really important inflation hedge. And then I think Anthony was alluding to was the fact that these are private securities. So these private securities can't be traded on a Robinhood app. You're buying a share of a physical building, and you really are only able to really sell it to other potential investors in that deal or the general partnership team. It's restricted for a reason. And that time, and some people look at the restrictions and say that's a bad thing. For me, I actually say, hey, it's one of the best things possible because that's what keeps cooler heads involved. Because during COVID, when the stock market was down 35% or year to date today, the NASDAQ, for example, is in that percentage as well. You know, people are panicking. But when you own a private security, because you don't have that option to sell, then it's a much more even tilt. And then that evenness actually helps you stay cool and actually make a business decision instead of an emotional decision. So I just wanted to jump in with a couple of those points.
It's a really good point. I'll jump over also to tax benefits. So on the properties themselves, there's actually tax appreciation. Like for instance, this year, say you put $100,000 into a real estate investment, and you had $150,000 of capex, which is like capital expenditures. There's that and depreciation as well, and you're going to end up having like a negative gain, even if you get paid back this year and you have some dividends. It offsets those taxes that you would be paying, and actually can help also to a certain percentage with your W-2 income as well, depending on how much you make. But you have to talk to your accountant about that. So there's a lot of benefits with investing in real estate. Say you have multiple real estate investments too, and you just sold a property and you had $50,000 gain or something like that. Another investment can offset that gain for your taxes, so you're not paying a large amount on it. So the depreciation really helps on an annual basis for reducing the tax burden. All right, and that's a lot of times why you see a lot of wealthy individuals, they don't pay much of any taxes because they have so many. They're doing what the government wants, which is incentivized through tax breaks. So that's how it works. So you follow the tax code of what they want you to do, and then you're going to get the breaks because you're actually creating opportunity and jobs for others by doing those things. Leverage, right? So 100% of the benefits of the large property, you basically have that, and you were only paying down a certain loan to value. So in the other case of the Oxford Village, I'll just use that as the example. We ended up putting down 30% of the funds, and then the bank covered the other 70%. So, you know, that's leverage right there. And then basically being passive. So when you're investing in a large deal like this, there's a general partnership. So actually Dennis, myself, and one of our other partners are the general partners on the 50 unit that I was talking about. And then we have limited partners also. We have a little bit over 20 or so in investors who are limited partners. And those folks, they don't have to go and do things that we're doing on the property. You know, they're not obligated. It's a truly passive investment. I do have investors I've worked with who are passive, but they also want to learn and start investing themselves too. So they actually do come to the property, and they do attend some of the inspections or other things that we have going on. And that's always an option for you to grow. And that's actually how Dennis and I met, because we were both going to check out a property with another operator. And, you know, I invested with other people because I want to learn as well and apply that to what we're growing also. So you do that and keep applying it to what you're working on as well.
So let me go back to the screen. Let me jump in really quick. So one thing on the tax advantages that's important to know is there's a golden saying, it's passive offsets passive. So if you do have a W-2, then what ends up happening is the passive losses that you get from investing in a syndication usually will wipe out any other passive income you might have. Now, in terms of active income, that's when it gets a little trickier. Now, one really super powerful strategy, and I'm not going to go too much in detail, is when one member of the household is at home with the kids, and then one member of the household is a high W-2 earner. What ends up happening is the household member who is not working, they become what's called a qualified real estate professional. And then what ends up happening is there's certain rules, and you want to check with your CPA. But what ends up happening is when that member becomes a qualified real estate professional, then all their losses now become active losses, and those active losses can now offset other active income like W-2. So in a situation where one member of the household is a doctor who's making $500,000 a year, and the other member of the household was just at home with the kids, if they get themselves to the point where they could qualify for a real estate professional, it's not unheard of where they invest into maybe $500,000 worth of projects during the year, and all of those losses will actually offset the entire income of the other W-2 person. So there's some really cool creative strategies that you can do. Also, interesting enough, so with leverage, I know Anthony talked about us putting down 30%. What ends up happening is that's 30% of the cost of the property. But in our situation, when we did Oxford Village, the appraised value was actually higher than the cost. So we purchased the property for 5.725, but it ended up being appraised at 6.4. So we actually ended up being at close to 40% of the value of the property. So while still the bank didn't have to change their actual distribution to us. So it was actually really, really powerful in that situation. And I think Anthony mentioned passive, he did that really well. So I just wanted to shine in with a couple of those quick points.
Yeah, that's instant equity too. So they always say you make money when you buy. That's why it's so important to really buy. You can't change the location. You can't change that purchase price after it's done. So those are two very important factors you want to consider. So that equity is right there right off the bat, which is super important. All right. So inflation, this is from a little while back. Inflation is
this is 2021.
Yeah. So it's it ended up being closer to just under 7%. It was over 6% by the end of the year. And this year, I think we're over 7% already. So inflation's gone out of control, and just keep printing more money. That's how we pay for this.
Why don't you talk about how we got that special mortgage product with Freddie, because it was affordable housing, and that adds an extra layer of protection.
So there's a affordable loan process with Freddie. We went that route instead, and it gave us an extra at least 0.5% interest less than other rates, and that also was originally going to be a higher loan to value that we were going to be able to take out, but with the whole inflation hitting right before closing, they changed their loan to value on us. But otherwise, we were probably going to have about 24% down, and we could even got down to 20% had the numbers been better by the operator, but it was hard to sell that. But we know what we're going to be doing with the property. They were operating that property at close to, I think it was 78% of the income was going to expenses, which is super high. We're working that down in the 50s, and that's part of our business plan that I'll talk about.
Yeah, and it's interesting to know. So when it comes to commercial real estate, the mortgages are actually not provided by like your local banks. They're provided directly by the agent. It's called agency debt, and that's Freddie and Fannie Mac. And what ends up happening is when they actually have a mandate, because they're not actually government institutions, but they're kind of governed by the government. It's a little bit of an interesting. They're like quasi-government, but one of their mandates is actually to encourage affordable housing. So what ends up happening is, besides the rate reduction that our investors got on this deal, they also take priority if two deals go into the queue at exactly the same time. The affordable housing deal will take priority, because of that mandate that Freddie and Fannie have. So definitely a couple of interesting little pros that we discovered during this acquisition.
All right. There might be little kids just trying to enter my office. So if they do, I'll have to just pause for a second.
Go ahead. I can take over if they do, so don't worry.
It's locked, but they can figure it out too. All right. So another area we want to touch base on is the importance of having the right team. And that's such a huge factor. If you don't have the right players on, it can really slow down your deal, slow down operations, and even ruin a deal. You can have, this is a good quote actually, you can have a great operator that can save the worst deal, but you can have a bad operator that actually can ruin the best deal. So it does play a huge part in success of a business. So all right, some background I talked about. I'm actually by trade, I'm a project manager, so I do project program management in the healthcare industry. Now I've done it across the biotech pharmaceutical side for a good 10 years, and also dabbled in the finance and telecom industries as well. So project management is just a skill set you can take into any industry pretty easily. And just like real estate, it goes it was just a really good fit to be an asset manager, because we're dealing with schedule and budgets all the time. So it was just second nature for me to go and pick that up and manage the properties and operate them. And like Dennis was saying before, I love that attention to detail, and that's something I like to focus on, and that's basically what I've grown up doing. I've met a lot of really great asset managers that have that project management experience too. So it's a good background to have in the industry. Yeah, so we basically had about 65 units by 2018 across 13 properties, and then just started going to bigger buildings and selling off the smaller stuff. So we'll continue going in that direction. And the affordable side is our niche now, and that's where we're traveling down that path, because we're very specialized in it. And I'll talk about, you actually have to have experience in order to get approved by the state, the Pennsylvania Housing and Finance Agency, to purchase a property that they have a loan with. You have to get approved by the local housing authority in that county. And again, you must have that experience. And then if you're the loans that Dennis mentioned, but that you're getting from these government agencies, you have to have experience also in order to get those loans. So that was a huge part, kind of building that up over the course of several years with affordable experience across different states and counties. And then I did it on a small scale, and then I went to the 22 unit, and that was where I met John. And he's taught me so much, and he's actually our other partner on the 50 unit. And his experience is incredible. He's a real go-getter, so someone awesome that I've really enjoyed working with, and it's been a great partnership bringing him in for our next deals. And it's impressive what he's been able to do with turning around other properties, problem properties, and basically being a property manager of the year with a massive company across the nation, where you probably have a few hundred property managers, and he was top one in the country. So a great partner to have. And then Dennis also, his background is already the book he wrote is awesome. There's a lot of golden nuggets in there, and like he gave you the background already, how we met and stayed in touch and just kept talking on a weekly basis, and that's what got us to this point. And we definitely have different strengths that make it such a good working team. So I really, really enjoy working with John and Dennis on these projects too, because we do have different strengths and different points of view when we're analyzing things too. All right, so the Rate Property Management team, the company we've been working with is MMs Group. So they've been around for 40 plus years. And they have over 38,000 units that they manage. So very experienced company that we work with, and they're based out of the New York area and Philadelphia as their hubs where they basically started. if you see that in the back there, that's the Oxford Hotel. So that's the property, the 22 unit down the street from the Oxford Village that we were talking about. This is the one we purchased in 2018, and we actually did a full facelift on this building. So it was
Anthony,
really run down when we got it.
1 second, can you go back to the prior slide? I just wanted to mention something.
Okay,
So on the
downtown.
bottom, so yeah, this is downtown Oxford. This is Oxford Village Residence is located maybe a mile away. It's definitely in walking
Not
distance.
even, it's like half a mile, yeah.
So one thing we wanted to, I really want to point out is, even though the property management company that we have has over 38,000 units, they have a special division that handles affordable housing, because affordable housing is its own unique monster. In affordable housing, you need a special bookkeeper because a lot of the books get audited. You need a compliance team, you need legal, you need all of that stuff. It's not the same. So a lot of people, you know, I talked with other operators, oh, you're in affordable housing. All right, who's your property manager? And they'll name me a property manager who has, you know, 600 units, half of them are Class A units. They're not gonna be able to handle the paperwork and the complexities and the recertifications, all of that stuff that comes along with affordable housing. That's why when Anthony mentioned he has a relationship with MMs Group, I really dug into them, and it was really interesting to see that they had so many divisions, and each division handled a very specific asset class. And that's what we really liked about MMS is, it's not that we just talk with our property manager and the regional manager, is we are in email threads with compliance, we're in email threads with the legal team. We have this nexus around us of these different team members that we get from MMS, and it's all because they have affordable housing. So this is kind of like a tidbit. If anybody's on this call, is if you're interested in investing maybe in affordable housing with a different operator, ask them their property management company, and then drill into that property manager, go on the website, make sure they actually have a division that's focused on affordable housing, because the last thing you want is a property manager who's dealing with a Class A tenant who will never ever miss a payment and has an 800 credit score. The last thing you want is for them to be taking on the same client that has these strenuous background checks and, you know, where we need proof of income and all of these different things. It's a completely different animal. So really, really important tidbit. Make sure the property management company that you're going to be investing with has that affordable housing experience if you're going to be investing in a different affordable housing project.
Yeah, and actually, when I was purchasing this building here, the 22 unit, I interviewed about 4 different companies, and there was companies that had no affordable experience, and they were salesmen basically. So you got to be very careful. People that I knew owned the company too, and I liked them, but they just didn't have the background, and I probably would have had a big disaster had I chosen my friend his company over. Not that they aren't good, but like Dennis was saying, they specialize in your Class A kind of properties. So that would that's very important for when you're choosing the right property manager to be specialized in what you're doing. And then also they have referrals, they have contacts in place, so you can leverage those things also and really move things a lot faster.
Anthony, what year was Oxford Hotel apartments? What year was that built?
That was built in the 1700s. 1764, somewhere around there.
And it has like President Grant's signature on it, right?
Ulysses S. Grant, and his name is signed in the guest book as President of the United States. So it has some history.
But when I was talking to Anthony, like on our first car ride, I was asking him, because there's a golden rule in real estate. Usually, if you add a decade, you usually add 10 percentage points to the operating expenses. So I was really skeptical when I had my initial conversations, because I'm like, Anthony, what are you running Oxford Hotels? This thing was built in the 18th century. Are you operating this thing at 300% operating expenses? He's like, no, I'm in the high 40s. I forgot what he told me. And like, I couldn't believe it until I actually looked at the numbers, and I ordered these numbers for like 2 years. And that was like a testament to Anthony and John, because they were able to have this 18th century property, which is one of the oldest hotels in the country that was eventually converted into apartment building. They actually were able to maintain such a low operating expenses. I felt so good when Anthony was showing me a property that was built 1998, I was like, wow, we could do really, really well here if he does 50% operating expenses for this 18th century vintage building.
Yeah, and the operators we bought this property from, they redid it in 1994 with the low income tax credits. So they have a 30-year period on those. And that means in 2024, I think that's going to expire for us. And at that point, we have the opportunity to go back to market rate rents, or we can renew and stay at affordable and get additional tax credits. So that's a whole nother ball game and game plan there that like people don't have any idea about, but it's a really good leverage, because if you're saying downtown Philadelphia and you're in an affordable rate, and the rents there are like just went up to like say $2,500, $3,000 for a 2-bedroom, and your tenants are currently paying maybe $1,800, $2,000 because it's an affordable property. You have some serious arbitrage there when your period expires if you don't want to continue and take additional tax credits. But it's a win either way for you. So
Yeah.
just that's something to it's a whole nother discussion, but I just wanted to mention that.
Yeah, and just to piggyback on that, we were looking at, Anthony sent me a property outside of Philly. I think it was in Philly, and the affordable housing rent was $825 for a 1-bedroom. And once it goes market rent, it's going to be in that ballpark of 2,000. So it's pretty significant, the arbitrage you could see in these type of investments.
Yep. There's definitely a lot of benefits there. But yeah, this was a heck of a project. We got quoted $200,000 to do that facade, but we ended up doing it in-house because we have our own maintenance division, and John, our other partner, he basically ran it, and I worked with him on that very closely, and because of that, we were able to do it at near half price of what we were getting quoted. So it was awesome, and a great overhaul, because that's the dead center of the downtown too. So. Oh, and it's a registered historic national landmark, by the way. All right. So the Oxford Village, this is actually the site plan of it. So it was built out, a 50-unit property here going in. We'll talk about it's a nice sketch from the architectural plans that were done back in site plans in the day. Key terms, the differences of vouchers. We'll talk about those areas, the affordable housing business plan, which we've already alluded to, and some of the like we said, off-market deals and the arbitrage that we're looking at there. All right, low-income housing tax credits, that's what LightTech is. And it starts with a 15-year period. So say like the village was built in 1998, Oxford Village. That had a 15-year period and then a 15-year extension. So that affordable housing will run out in 2028. At that point, we have the opportunity to take it to market rate rents or renew it for additional tax credits. And you know what, I forgot to mention, Dennis, when we had the Oxford Village underwritten, and we bought it at 5.725 million, it got appraised at 6.4 roughly. And with market rate rents, it actually had an $8.2 million appraisal. So that just gives you an idea. And that was today's rents, kind of market rate.
And that's something unique. You don't see that many in other appraisals, but because this is affordable housing, they actually gave us both numbers. So they gave us the numbers on if we remained affordable housing, and then they gave us the numbers of what happens if the income restriction falls off and what we would expect to see. And the cool part about that is then, like, we get this question all the time with affordable housing. They're saying, well, in 2028, are you automatically gonna let the restrictions fall off? And the truth is, it becomes a business decision, because in 2028, we'll know what the market value is for that property with the restriction off. And then we could also determine, well, maybe we're gonna hold this project for the next 10 years. So let's see what tax credits we can get and compare the two. Because if it's significant enough, let's hold on to it and let's renew for another 15 years. Or maybe, you know what, we're not gonna make up that difference in years. So let's let the restrictions fall off and let's sell it at that higher sales price and make a good return for our investors. But it takes away any emotion from the deal because it's just a numbers decision. It's whether or not are we going to get more money with the restriction falling off, or are we going to get more cash flow and more money with renewing the tax credits. So I really love that part about it. Yeah, go ahead.
Yeah, and there's a game plan behind how to do everything, and it's not about displacing tenants at all. So you're never going to be doing that. You just have to work a business plan into how you're going to move the property or renew on and take it long term, whether you're going the market rate route or affordable route. The average median income. So we actually there's 40%, 50%, 60% of your average median income. We have 50 and 60% units at the Oxford Village. So those are a little bit reduced rates. For instance, maybe the rent is $1,400 for a unit, but with the 60% average median income, they'll be paying $1,300. And if they're 50%, maybe they'll be paying $1,200. So that just gives you an idea. It's more a reduced rate, full rent for people to pay, but that's part of the affordable deal that you're working in. And when you analyze your properties, you're underwriting it for the rents that are in place, but then also you have to figure out what's the market rate that you should be getting. And we estimated for this property that we'd be increasing the rents to maybe $75 a piece in the first year. Our numbers are going to be much higher than that because, as we found out after when we did our compliance review, some of these rents were $200 under value because they hadn't raised these rents in 3 years. So, with the inflation being set, you typically do 5%, 3 to 5% raises on your rent, but when the inflation's 7-8%, you're never going to get caught up to that doing that. So we're working with the housing authority where some of these bumps are going to be 30%, but then again, the tenant's only paying 10% of that rent. So it doesn't hit them hard at all, even if it's a 30% raise. So, and then at that point, you're just doing your standard 3 to 5%, staying with the market at that point. Sorry, for vouchers before I jump. So I mentioned before the tenant-based vouchers and also the project-based vouchers. I know I mentioned the tenant-based voucher stays with tenant, the project-based ones stay with property. Project-based ones are definitely a good asset to have. And I mentioned that tenants, they don't want to leave because they'll lose that voucher if they walk away from your property. So it's actually a good incentive. And also they'll take care of things more timely. They'll be more responsible because they want to maintain that place and keep that home. Dennis, in respect of time, I'm going to fly through these a little bit faster. Okay.
Yeah, go ahead.
So if there's anything you want to touch on more heavily, just let me know.
Yeah, you got it.
So we already mentioned some things on the barriers of entry. The biggest part is the business plan. And like I mentioned, the expenses are typically at 80% or so or more. We just looked at a deal that was operating at like 105%.
Yeah, 110.
110%. So the income is 100%, right? Your revenue, but their operations were costing them 110% a year. So you're losing money on the deal. They're trying to sell it because of that, but that's something we can tremendously trim back. There's a lot of fat the way these big companies operate, and you do have to really pay attention to detail to cut these numbers down. And there's so many times that I go in and we take on a property and we find out they're paying for all these services that never even existed. or even like we just found that we got a second water bill recently at the village, and it's for something that has never been used.
It's for an irrigation system that wasn't never on the property.
And they were paying that on a monthly basis. So, all these things we're trimming the fat down. And there was a security system that was, or they're paying for certain sprinkler systems alarm systems that didn't exist because they're townhomes. It's not an apartment building. These kind of things that we're finding out. So, the financing terms, we mentioned that already. There's better leverage there. And the occupancy is a very huge thing to talk about. I've bought properties like around 80%, occupancy, but then we've been running it at like 98% occupancy after that. The current property we bought was already at 98%. And we're going to be operating at that level consistently because we already are developing our wait list out for it. So, that tends to be better cash flow long term. You're not going to have, if you look at these add value deals, you go in, you start raising the rents and you start turning units because you want to actually get the tenants out so you can turn your unit and then charge a lot more. But then your occupancy can drop down to like 60, 70% if you don't do it carefully. And that crushes your cash flow in the first few years. We're not losing that cash flow the whole time. We're gradually going through and just upgrade. We're making the unit upgrades and all those improvements along the way. But we're not doing it to a point where we're pushing out tenants and crushing our occupancy numbers. I'm a limited partner in other deals too, where I'm looking to learn. And some of those operators that we're invested in, you bought the property at like 94% occupancy, but now you're at like 84 occupancy because of what you're doing, and that crushes your cash flow. So we're not getting dividends now. That's not ideal. That's definitely something you want to watch out with when you're investing with certain parties too. Okay, so vouchers, I'm not going to dive in this too much, but there's a lot of details around that, and we can do a whole session on the vouchers and the affordable space and the benefits and how to leverage certain things. So just the business plan itself. So we basically have a total, when we purchased the property, their net income was $626,000. I think right now we're already targeting $655,000, and it'll keep going up from there. So the total expenses they had was $477,000. So their net was only $149,000. So that's 76% of your expenses. There's like of your revenues going to expenses. That doesn't leave much to play with. So what we're focused on doing is getting that down closer to 50%. If you can get it under 50%, I've done that for some of the other properties, but it's hard. But your returns are great. Like some quarters we're generating anywhere from 10 to 18% back for our investors on dividends because we're able to trim those expenses down so much. And then of course maximizing your market rate revenue for your rents.
Yeah, and a lot of people wonder, why are they doing that 76 and we could do it at 50? And the reason is because me and Anthony couldn't get together and develop a brand new project from the ground up, and they could. And the reason is they are great developers, but they are not great operators. And we are great operators and we're not developers. So, but the problem is the way these tax credits are suited, if these tax credits weren't set up the way they would set up, realistically speaking, a company like the ones we bought it from would just build up and then they would sell right away. But because the tax credits are set up where they get so many benefits for the first 15 years or so, they hold on to these properties, kind of almost like grudgingly so, where they already kind of made their money in the development.
Made their money in the beginning.
Yeah, and now they kind of have to hold on to it. And what they end up doing is a couple of these bigger expenses, and we're going to drive into the individual ones. They overstaff, they do a bunch of things. And that allows us, because we didn't develop this property, we have no emotional connection to this. We come in and, okay, where are they high? What can we do to get these numbers down? So it's not as crazy. So when people start seeing these numbers, they almost don't believe it. They're like, how could you guys shave off 140,000? And the reason is, it's this simple. They are fantastic operators. They are not, fantastic developers, and they're not operators. And we are operators and not developers. And that's the bottom line. And we'll show you guys what that actually means in the next couple of slides.
And when you think about any big company, there's so much fat that can be trimmed off when you're dealing with just a big company, a big outfit where there's less oversight actually happening. So some of these people are monitoring 30 properties or so, and they're not able to keep their eyes on what's actually happening. So they don't see everything, and it's shocking to us because we're actually looking through the details, but that's just in reality what happens. Like we found out that the property, the Oxford Village one that we got, the rents, they were renewing leases every year without raising the rents. The first lease we got where that happened, we flagged it, you know, but
Yeah.
that's been going on for 3 years with them, the previous owner. So those kind of things. And that's how sometimes you can maintain a really high occupancy if you're not paying attention to those things and not realizing what's actually happening. So lessons learned there. But for expenses, like where there's arbitrage that Dennis was talking about, 145,000, and that's our first year plan of what we're doing, and we're on track to do this too. There's always a lot of expenses in the beginning when you're taking over a property, so it's front loaded, and then you kind of smooth out after, because you want to turn that property as fast as you can to get it to where you need to be. Like we did a water saving initiative right off the bat in the second month of owning it, and that was because it's going to save us close to 10 to 15,000 a year. It costs us maybe 14,000 to do, but that's going to be repeated savings every year now going forward, where we reduce the water consumption. And we're working on several more projects to do just that also. Dennis already mentioned the fat around the payroll, which was like a huge area to cut off. So you can see the projections that we had, and that's what we're working towards. Instead of staffing a maintenance person on payroll, we're doing 1099 for a few days a week. And that allows us to really trim down those expenses. Otherwise, you're paying benefits, you're paying time off, you're paying full-time when you don't need them full-time. So that's all those areas that we're also we trimmed off through, and that was through our partner John's expertise, because he really is excellent at the maintenance side and really trimming the fat off that, and actually getting things done effectively and really well done at an effective price too.
So I'll just hold on, and let me go back to the slide. I just want to mention really quick. So Anthony mentioned that we kind of have our own main team. It's really John's main team. But what ends up happening is, in our situation, we're saving so much money with the main team, and then we're also saving money on big projects. So the water efficiency project that Anthony talked about, I had it quoted from 3 different companies, and they were quoting us close to 35,000 to do this project. It's a big project. You'd have to come in, you have to change out all the toilets, all the shower heads,
75
all
toilets.
The aerators. Yeah, so 75 toilets. It's a very, very big project. Usually these third-party teams, they come out in a team. And we did the exact same work, and we saved $20,000 from our budget in year 1. And that's not even including the water savings from year 1. And then a couple other things I want to mention was advertising, right? We have a huge waiting list just by dealing with housing. But the previous owner actually was spending money on subscriptions to apartments.com. It just didn't make business sense why they were doing that. And then like insurance, they were getting a portfolio case, and you would think they were getting actually a better deal, but because it was a portfolio, it didn't actually address the fact that Oxford was a very low crime area, not in a flood zone, and a very low risk insurance policy. So by us actually removing it from the group policies, we actually saved significant money. And then management fee, I just wanted to throw out there, was they had their own management company managing it. And what ended up happening is it's more of an accounting game than anything. And they were charging 10%, and that's double the industry norm. And they didn't care because it was their own LLC.
It's going in one pocket and going in the other.
Yeah, exactly. So we didn't have to play those games. So a lot of these big expenses, like $145,000 seems like a lot. But once you start putting it on paper and go line item by line item, you're like, wow, this is actually really reasonable to hit. And now, you know, a couple months in, I think we just finished our first quarter. We're like, we might even beat $145,000 reduction. And that's on top of the fact that we're suffering from a lot of inflation because the water rates have gone up, all these different things have gone up, but we were so preemptive about it, where our water savings and all of that stuff is going to negate a lot of that inflation and still produce significant savings for us. That's all I wanted to mention.
Yep, no, good. Good to touch base on those items, because those were some of the largest savers right off the bat that can move that needle big time. So when you guys are looking at other properties, those are some very simple areas to take a look at where you can produce a arbitrage for yourself to make those savings. We already talked about this is actually the broker's opinion of value. So they were trying to sell this at the 6 million mark. We actually we came in at like 5.8, then we were able to knock it down to 5.7 when we did the underwriting and identified some gaps in the rents. And other projects that had to get done, like a $55,000, $56,000 sewer pump that needed to get replaced. Like, these are things you really have to pay attention to. If you don't pay attention to those details, we found those by looking through the service records and looking over that for the past 2 years. If you identify areas where there's constant repairs, you should pay attention to that and go check it out thoroughly and have it inspected, because most likely that's going to be a big problem for you when you take on the property. If we didn't have that budgeted, a $56,000 repair without having that accounted for and getting a credit or anything for it, that would have really hit us. that would have knocked out any gains in the first year for dividends. So, you got to be very careful on those things when you're underwriting and then analyzing your properties. And that can, if you're doing single families or smaller units, think about that for foundation issues, or even like, replacing roofs. The biggest expense is your plumbing. Maybe it's cast iron that has to get replaced out because it's old. I've had that on multiple houses in Philly where we had to go and replace it, go into the main line from the house, and you're digging up the sidewalk and all those things that cost money. So you have to account for those things still. But anyhow, we ended up purchasing at the 5.725 mark. So we had pretty good arbitrage from the start. We did have a lot of work to do, but we're doing it and moving along just as planned. You want to mention anything else on this one?
Yeah. So really quick, a lot of people ask, well, if they got this broker's value opinion between 5.8 and 6.45, then why would they ever sell it to us for 5.7? Why didn't they just list it on the market? So there's a couple of reasons for that. One is because if they have to pay a commissioner, broker's commission. And if you actually factor in the broker's commission, we're actually right in the probable zone.
It's $300,000 almost.
Yeah, and then the second biggest thing, and this I can't stress enough, is what happens is HUD and these affordable housing deals, they actually got to get approved by the third-party agency. In our situation, it's Pennsylvania Housing and Finance Authority. What happened with the seller is the seller had a history of going to the broker, and the broker would get him these crazy bids, and then the person who outbid everybody would get to the finish line, and PHFA would turn around and say, you don't have the affordable housing experience. We can't sanction this deal, and then the whole deal will fall apart. So what they would rather do is they would rather deal with a select group of buyers like me and Anthony, Anthony in that case was already approved by PHFA. They already had that confidence level.
Yeah.
They had that history where it was actually the exact same seller for Oxford Hotel. It's the same seller here.
Same state rep we worked with before.
Because of that history, they felt comfortable about us coming in lower than what they thought they would get on the brokers, but to give that 100% assurance that the deal will actually get closed.
It's pretty important. Just like any deal, you want to get it closed, right? You don't want to start for no reason and then waste all that time and then have to restart.
Yep.
Okay. There you go. We just talked about all that. Everything on the bottom. This is a real life example. So the pool size, like Dennis was mentioning, right? If you don't have that experience, you're going to be limited on what you can do with these deals, because one, you're not going to be able to operate it, and you're not going to get approved for it because it's a little bit more complicated. But then, like we were talking about, after 2028, the buyer pool opens in size, right? Because this can be market rate, and if we want to sell it at that, and then boom, we have that many more buyers, or we go and get tax credits and keep this. When the cash flow is 10 to 20% on a dividend, then why would you want to get rid of it? That's like such a good hedge to have a long term. So.
Yep. And when it goes market rate in 2028, that means the seller no longer needs to be vetted by PHFA. That means we could actually go to the broker, get a traditional bidding war, and go with whoever the best offer is, because they no longer need that approval from PHFA. So it's a really sweet arbitrage. And in our situation, that value of that expiration was worth close to $2 million.
And I'll also mention, we actually took out one layer of complications when we bought this, because we don't have financing from the state anymore. We paid those loans off with our purchase. And because of that, we're not subjected to annual reporting and audits. Well, any reporting we do, but sorry, we're not subjected to the audits and all the additional paperwork that the state requires, because we don't have a loan from them. it's from the government. It's from Fannie, the federal level. And that's more of a agency loan rather than a state subsidized loan. So that, yeah, and so there's a lot of different benefits there anyway. But yeah, let me just jump over. One of the other areas we'll touch base on, like this is, you can see where Oxford is in Philadelphia. So Philadelphia is actually the closest major metropolitan area. So those are the affordable rent rates that we get averaged against, which is awesome because it's a pretty high rate compared to what Oxford is. So it's like arbitrage for us there too, where that actually benefits us by having slightly higher affordable rents than maybe some of the market rate rents in that area. So that's another area you can look at for arbitrage for yourself. And when you're looking at properties and you're thinking about going the affordable route. Right. And then Oxford has been a steady market. Some people think, okay, why would I invest in a small town? You know, it doesn't have much growth, but it's stable. And when you're dealing with affordable also, you have a wait list of people for your property. There's only so many of those available in the area. And with this inflation and the way everything's going, affordable living is constantly, it's becoming even more in demand. So this has been happening since the 80s, right? I haven't seen the affordable housing market go down where it's only been increasing for that need. All right, so rent arbitrage, that's what I briefly touched on. Jump over. Okay.
And let me go back to that slide 1 second.
Yep.
The previous one.
Yep.
So one thing I want to mention over here is, you know, I'm from New York City, and what ended up happening with these LIHTC deals is they would have these lotteries, and it would be so hard to fill because, you know, someone that's making 80 to 90,000 puts in for it. They might win the lottery to get into one of these apartments, but what ends up happening is their AMI that's set by HUD won't qualify. So it's this weird like catch-22 because you have to be in a situation where you're living in a big city, so you usually have a big city income, but you might not be able to qualify to live affordably in one of these units. In our situation, we don't have that issue because we are, you know, 60 miles away from Philadelphia. So we have a lot of blue collar workers that are making $30,000, $40,000, $50,000. So usually speaking, we get a high qualification rate. We're not going through 10 different tenants just for them to qualify by AMI threshold. So that's a really nice aspect of it, where if we were in Philadelphia, that might not be the case, but because we are outside of Philadelphia, we actually get that arbitrage, and it's actually still, we get almost the same rent as if we were in Philadelphia, but it's just so much easier to actually fill the actual apartments because it's outside of Philadelphia.
Yep. All right. Move along a little bit faster here. I know we're short on time. So that's what people used to think of with affordable housing, but you've seen pictures in the background of what we actually look to do. So obviously it's a nice, beautiful, high-class living style. Here's actually the floor plans of the three and two bedrooms that we have at the Oxford Village. And it's great living. You get 3 bedrooms and 2 baths, and you have and then the two bedroom, 1 bath are the other ones. So these actually have washer and dryers in there. So they're fully equipped kitchens with dishwashers. So, you know, you have all the regular luxuries there, your HVAC systems and everything. There's plenty of parking for everyone. They're nice units. All right, so Dennis, do you want me to touch base on the case study with the previous property? Actually, there's a nice picture. That's the Oxford Hotel before we painted it and redid it. So the bricks were actually spalling and falling apart, and we had to reinforce them and seal them up before painting. There used to be a balcony on that side. There's a whole lot of things we had to do to take care of and cap things up before painting and revitalizing that property. But
So just from a high
yeah.
level return perspective, how does it look for an investor that invested in 2018 for this investment?
Okay, actually, as of last month, everyone that invested got their full investment back in 3.5 years. And on top of that, the property value we purchased that at 1.115, this is over 2.2 million now in value. So that your equity is still there, even though you got your money back. That's called infinite returns. Our quarterly dividends are on average 10% at a minimum. And it's gone up to 18% at times. So in the beginning, the first year was probably around 5 to 7%. And after that, it just shot up because we got everything operating where we needed it. So you don't have any more money invested in this deal, but you're getting 10 to 18% back on a dividend every quarter. And then on top of that, you have your equity, which is doubled. That's huge. That's a serious asset to have long term. I don't think anyone's going to want me to sell this one. So it's a great asset to have in your portfolio. So that gives you a good idea. The Oxford Village that we're working on, this is a 4-year hold, or not, sorry, a 10-year hold. And we're projecting getting about 80% of the income back to investors by year 4. So that's what we're projecting for this one. We could do better. We'll see. But, we were conservative with what we were shooting for. And we did say that we were looking to do, we are doing a 7% preferred return, but in our first year, we projected it out being closer to the 4 to 5%. At the rate we're going, we can hit that pref potentially for the end of the year, but we're working through that now. So, and yeah, this is a great buy and hold also. And like Dennis mentioned, we bought it at 5.725 mil and it appraised at 6.4. We know it's going to be worth even more than that by the time we're ready to sell this later down the line. So you have some instant equity there too. This size most likely won't double in value, but think about an extra 2-3 million on top of that for everyone, right? So then that's doubling and on top of that, this is one thing I didn't mention. We're not doing interest only. We're paying in principal and interest from day one on our loan. So $70,000 to $80,000 a year is being paid down on principal, which is huge. So that's additional equity being gained every year as we pay the mortgage. A lot of these major operators were able to create more leverage by doing interest only for 2 to 3 years, but that means you're not paying anything down in principal. So some of the operators I invested with, that's what they did. But then that's how they're able to return some dividends in the beginning. So think about the equity gain that we're going to have on this one. So
yep.
Anything, yep.
Yeah, I was gonna say, like, we're projecting. A lot of people say, like, well, why are you only projecting 10 years? Why are you projecting 10 years? That's a really long hold. The way that Anthony and I are looking at it is, if we could return all money back from investors, then who cares? Why would you want to sell it in 2-3 years? Because what happens is, a lot of people that got started investing in the last decade or so, it almost didn't matter when they invested, they double, tripled their money after 2-3 years. We're going into a market right now where we're actually facing headwinds for the first time. So for the first time, it's actually prudent not to take interest-only loans, actually pay down that equity. So we're projecting at the end of the 10 years, we'll be down to 3.1 million if we hold it. Now, in reality, the 6-year mark is going to make a break for us, because in the 6-year mark, the income restriction expiration falls off, and then it's just going to be whether or not we should sell it for the extra bump that we'll get when that restriction falls off, or continue hold on. But I think we're going to be probably holding it at that point. And if we're holding it at year 6, then most likely in year 10, we might refi into like a special loan, like a HUD loan that's amortized for 35 years. But we'll only have $3 million worth of debt, and potentially this property might be worth 8 to 10 million at that point. So it'll be a really nice project where maybe if we do a refi in year 4, we might do another refi in year 10, and then do a whole nother return of capital to our investors, as well as their distributions that they would get.
Yeah, and we can even do a secondary loan instead of a refi earlier on. That's probably the better route that we'll go.
Yep.
But we'll decide that later. Let me just jump over. That's it. Yeah.
That's it. Let's see if we
Okay.
have any questions. I don't think any questions came in, but let's open it up to any questions.
I know
We'll
we
stay
ran
on.
late, guys, so thank you for holding on. I can't see everyone, so
If you hit
Take the
participants,
share
you
off.
should be able to see it.
okay. Am I still sharing here?
Yeah.
I am.
And that horse farm is actually, that's the neighboring property of Oxford Village. I always tell Anthony we have a free amenity because people can just go down and watch the horses.
Okay. That's funny. I have 3 monitors and the share was all the way on the 3rd monitor. I couldn't even see. There we go. Looks like we had some questions come in.
No questions
No?
so far.
Okay, all right. All right,
We'll give it
let's
another
see.
minute or two. If we didn't have any questions, then I think we're good to go. Oh, wait, I think Tara has a question.
All right.
Let's see. I'll just allow her to talk. Let her ask. Hey, Tara, feel free to unmute yourself and ask.
Or you can type if you can't.
There you go. She
No,
unmuted.
I said I like what I hear. It sounds good. Yeah, and I went to see the unit with Anthony.
Oh, she was there. Yeah, just a few days ago.
It looked lovely. Yeah,
If you want, we can put you on the waiting list.
I'll have to move back. California today or yesterday.
Yep.
Yeah, but I had fun in Philadelphia.
Yeah, it's a very nice property. So it's an awesome home.
Yeah. So I think you guys are doing a good job, and hopefully we'll get something in our return soon.
Yeah, we're working through with our accountants right now to get all
Okay.
that sorted out so that we can work on the
Okay.
first dividend.
Okay. Well, good job.
And,
You keep it going.
Yeah.
I learned a few things about all the credits, where it's coming from and whatnot. Yeah. And you have it recorded, so Chrissy wasn't able to listen to it, so she can look at it
You
later,
can send it out after, right?
Yeah, we'll send it out. Yeah.
Okay.
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 All right. Well, have a good day. Thank you.
Thanks.
You too,
Bye.
Tara. Bye.
Bye. Bye.
All right.
I think that's. Oh wait, anybody else? I think that was it, right?
I see. Yeah, I see Devin there too. Long time no talk. All right. Any questions, folks? Any other? I hope that was helpful.
I think that was great. I think we'll definitely share
Rajesh,
this for
yeah.
anybody that hasn't that missed it, and then feel free to follow up any questions. Maybe the question will hit you later today. Like, hey, I should have just asked this. Feel free to email me. Oh wait, Rajesh, I can't see him, but thank you, Anthony. That's so very far. No problem, Rajesh. It was our pleasure.
Yeah.
So feel free to email us. My contact information is dennis@sihcapitalgroup.com. Anthony, why don't you share your contact information? And you could reach out to either one of us.
Yeah, you know what? Let me just share the screen. It was on there. Let me just do that
It was on
again.
the last screen.
Yeah.
Yeah.
Let's put that back up. You can see that again?
Yep.
Okay. There's our phone number and emails. And I hope that was informative.
Thank you, guys.
All right. Thanks all.
Take care, guys.
Take care. Thanks, Dennis.